catalyst for a chat was 20 years of Paradice Investment Management. You both run your own strategies and have investment careers prior to Paradice. How did you meet Para? What was the initial introduction?
I used to work in small caps, and so I knew David, who was a competitor. And basically, I mean, everybody knows David. And if you go back, it was 2004. He'd had some staff changes, and he needed another senior portfolio manager. So he called me up, and wanted to catch up with me. And he had a great reputation, so I was like keen to catch up with him. But it was quite funny at the time. He used to leave these messages on my phone. It's like, "Hi Matt, it's David here," and then he'd leave these long messages. And you get to the end, he goes, "That's David Paradice." And he left messages like that for a year after I started working with him. And I think one of the most amusing things is to actually get us over the line, because we both came from a large place. He wanted to actually get my wife on side, so he took us down to. It was just around the corner here. There's a Chinese restaurant called, it was called Noble House, known as Chernobyl, and he took us there for a meal, and that was, and shortly after that I signed up. So
that was the intro. He doesn't mind telling a lengthy yarn. You don't always know where it's going to end though.
No, he'll take you anywhere. Yeah.
Was it similar for you, Troy? Was it sort of initial? Because yours is not so much the natural extension of the small cap strategy, which is where it started.
That's true, yeah. So I joined in, let me think, it's around February of 2007, and it was really post discussions I'd had with both Matt and John Lake, who had also joined Paradice. And Matt and I used to work together at a larger competitor, and then indeed we worked together at a prior competitor as well. So we've been working together for almost 20 years now. And so I had some discussions with Matt and John about the opportunities at Paradice, and I had a desire to start up my own fund and have a stake in a business, and Paradice just seemed like the perfect place. So we kicked it off at the beginning of 2007.
So in terms of your own investing views, like we're at an interesting point. It feels like the macro is a really powerful force that you guys are feeling as bottom-up stock pickers at the moment. I wouldn't mind starting just touching on some of your views on some of the big shifts. We had that move from tightening in the US through to a bit of a flip from the Fed and easing things, and it really seems to have put a little bit of turbo into the tank for equities. What's the view on what's happening at the fundamental level in these economies, these big drivers, first of all the US, and maybe we'll have a chat about China as well?
But in relation to the US, the Fed pivot, as we've called it, it was a pretty significant event, and obviously led to a significant rally in risk assets since the beginning of the year. And the reason for the rally really is a result of easing financial conditions, so in relation to both the cost of credit and availability of credit. Once the Fed decides they're no longer raising rates, a lot of liquidity frees up, and I think we've seen that reflected in risk assets more broadly. But equally, the Fed eased up principally as a result of the US economy peaking, and perhaps there's now an expectation that it slows throughout the course of 2019, which is broadly our expectation as well. You see a deceleration in US GDP growth as we go through 2019.
Deceleration from what was it was going at a pretty steady clip. So people often think of these things as sort of one end of the scale or the other.
Yeah.
It's a bit more of a middle of the road path forward for the US economy?
Yeah, for us, we're certainly not in the recession camp for the US, and you're decelerating from what was above sustainable levels of growth, so above 3.5% GDP type numbers, back to what we perceive to be more sustainable type levels at around that 2.5% over the medium term for the US, yeah.
Yeah, okay. Anything to add to the US picture? I mean, smalls and mids, much more esoteric, I imagine, in what drives the stocks, but we've heard a lot of people wanting to seek that offshore exposure, even in that small, and get away from the domestic economy.
Well, that's true. I mean, if you look at our space, we look at companies outside the top 50, so companies with basically about $10 billion market cap downwards. And a lot of those companies have actually gotten to a scale where they've been able to invest offshore. So we do have a lot of the companies we look at have operations both in the US, Europe, and Asia. So we do spend a bit of time, obviously not as much as our large cap colleagues over there, but the feedback that we've been getting is, if you actually look, last quarter of last year, and we actually, in particular, there's a lot of building materials companies that we look at that are exposed over there. That was quite a weak period, but it is fair to say you had a situation where you had mortgage rates had jumped up, and it combined with some, particularly bad weather. It was record rainfall in different parts of the US, and the feedback coming to spring over there is things are actually looking a bit better, and we've actually seen a 100 basis point decline in mortgage rates over there, which is helpful as well. So, there's a feel that things, it's not blowing the doors off, but we've gone back to gradual improvement again.
Sort of elongating that business cycle a little bit.
Correct. Yeah.
And what about China? It's obviously closer to home, seems to be a really powerful driver, and particularly for the domestic economy here.
Well, Troy has just returned from China.
Yeah, I was up there recently
What
actually.
did you say?
So China, the economy seems to be picking up at the moment, pretty much in line with what you'd expect seasonally. So it's a very seasonally based economy, and typically from post the Chinese New Year, you start to see a re-acceleration in growth, and that's basically what we saw. And principally areas related to fixed asset investment, so that might include the likes of building subways, roads, rail, electricity transmission lines, etc. All of those types of projects have started to accelerate as in the beginning of 2019, and that's supporting demand certainly for the likes of steel and iron ore and other commodities. So it was a reasonably supportive picture actually, what we saw.
And do you feel like the Chinese government, do you get the sense they got a good handle on, it seems it's a very managed process with the growth and the numbers that they're pulling. Do you feel like they've got it under control?
They seem to have, yeah. They've been pretty instrumental in implementing stimulus as and when it's been required to keep the economy on track. And it looks like, from what we saw, they've done it well again, certainly to date. In any case.
Yeah, I was there in November, and you could feel, things were definitely starting to weaken off. You had the issue, the trade war was starting to bite, and they've clearly reacted to that weakness, as they have time and time before. So obviously, what happens with the trade war, that's another. Will be another big swing factor going forward. So, we're sitting and waiting. So,
we chatted midway through last year, or just after the midpoint of last year, and you talked trade wars were really quite fresh as far as a point of conversation, and they were escalating at that point in time. And you sort of, we talked more about, well, it's going to be more interesting to see what some of the second order effects might be of that. Has there been any evidence, in your eyes, of what some of the flow-on effects might be of the trade tensions that we felt, particularly in the second half of last year?
Yeah, definitely. I think we witnessed it in the last half of last year, particularly the last quarter, and the second order effects really related to confidence, and particularly confidence of Chinese manufacturers. That trade war really impacted the Chinese psyche, from what we can gather. And they changed the way in which they went about business on the expectation that the trade war tensions would persist. And obviously we still don't know whether or not they will, but it's obvious post the stimulus that the Chinese government's enacted that the confidence has started to return to those Chinese manufacturers and other companies, and that's clearly supporting growth at the moment.
Yeah, Matt, in the smalls and the mid-cap space, one of the dominant themes that we've seen is the pursuit of some of these high PE growth and momentum companies, particularly those with decent liquidity and technology and big addressable markets. There seems to have been a lot of favour found for these stocks. At the other end, some of the more value style companies really seem to have been less below, particularly the cyclicals that are exposed to the Australian market. How would you characterise the opportunity set that's available to you at the moment, and sort of where are you finding opportunities, or what are you steering well clear of in that mids and small space? Yeah,
that's a good question. We're very much style neutral, so we look at all of the different companies in the space. Probably start off domestically. It's an interesting point you raise. If you look at, obviously the housing market here is the thing on everyone's lips at the moment, and if you look at, I think for the last 12 months, you've seen house prices down on average 7%. In Sydney, it's down double digit. Melbourne's close to down double digit. That's then started to flow through into approvals. It's also, gone into housing sales, which are down almost 20%. From the point of view of the domestic economy, it's actually been quite interesting. We've big ticket items have really been impacted. So car sales have come off dramatically. But if you look at things like retail sales, they've held up better than we would have anticipated. Likewise, employment's held up better than we would have anticipated. But I think the risk from here is if you actually go beyond housing, housing starts into housing completions, we're still at, there's that time lag, so we're still at a relatively high point. And if you look at the construction industry, almost 10% of employed people are in the construction industry. That's the highest since the 30s.
Yeah.
So I think the risk from here is that, as construction itself starts to roll off, we'll see that then, flow through to the employment market. And we've already seen, some of the leading indices like the job indices have started to tail off.
Yeah.
So we are, we're cautious in terms of the domestic economy, and throw a federal election on top of that, and the uncertainty that creates. The flip side, we might see a bit of stimulus starting to come through. We saw a budget last night. Whether it actually gets enacted or not, we'll see. But there was
sort of the less like, and if you look at the odds at the moment, it's sort of
true.
the one you should be paying attention to the next one, really.
Absolutely, you're absolutely right. So so domestically we are quite cautious, and we're actually underweight domestic cyclicals. And the market obviously anticipates these things. So building materials have underperformed, regional banks have underperformed, retailers have underperformed. And in terms of you come to the high P world. These sort of premium type stocks. I mean, we look at all of these. There are actually some, really interesting business models out there. You look at something like, Afterpay, for example. It's a very unique stock. It's actually, a really brilliant idea, and it's been well embraced by consumers. Xero in accounting software. We've talked to, other guys who operate in the space. They by far have the best cloud product out there.
It's interesting. We use it as a business.
Yeah.
The person that services my swimming pool uses Xero,
Yes.
and the electrician who lives next door popped around, sent me a Xero invoice last night. So it's not just for mainstream business, like everyone can use it.
Yeah, well, it makes it easy. Like, I'm an accountant by background, and the old systems were just really hard to use. So that's the attraction of it. But the big thing for us is ultimately, valuation, and Troy and I have been around for a while, and if you look at, what we're seeing today is really reminiscent of what we saw in the late 90s. You've got a lot of stocks on huge PEs, or the stocks actually not making any money that have large market caps. And it's interesting, you talk to some of the guys in the market, they're saying to you, valuations don't matter so much, but ultimately, the share price basically reflects the net present value of future cash flow. So while they might not matter for a short period of time, ultimately, valuation always matters. So we are concerned, and these things can continue for a while, but at some stage, it becomes unsustainable if the share price doesn't justify the valuation. So
yeah. Is that dynamic? It's probably not quite as prevalent at the top end of the market. Is it? You don't have those really esoterics or specific technology style plays like your Afterpays and that sort of stuff.
No, there's nothing in the top 50 on Infinity Times, I don't think, from what I've witnessed of late. So no.
But I guess the one anomaly at your end of the market, Troy, is the payout of dividends from the miners that have not traditionally been income style stocks, and there's been some big dividends come through. Do you feel, we talked again last time, we talked about them changing their spots and capital discipline.
Yep.
Do you see that trend continuing in these companies?
Yeah, it's likely to persist, definitely. Pretty much across all the major miners that we look at, so the likes of BHP, Rio Tinto, Fortescue, even the smaller guys, South32, Iluka, etc. They've all embraced capital discipline and the need for good cash flow returns to investors, and equally, more appropriately, not to invest capital at sub cost of capital rates of returns. And all of them collectively have been actually very disciplined to date. But cycles, they start like this, and they're like this through the middle, and they end when that discipline goes out the window. So we're not there yet, but it's something that clearly we're watching.
I think I saw a statistic that it may have been in large caps that in 2018 it was the first time that more capital was returned to shareholders than was actually invested into new business development.
Yeah.
Is that just a sign of what Matt described with Australia as just a lack of opportunities or slightly benign opportunities domestically?
Well, I think as it relates to the miners, it's perhaps the capital discipline we've spoken about, as opposed to a lack of investment opportunities necessarily. Because, as a miner, growing volumes does not always equate to growing value. And these guys have now recognised that. And the fact that, for example, the miners have distributed more cash than they spend is probably more a reflection on the fact that commodity prices have been at elevated levels and managed to stay there. So they're sharing those windfall gains with investors, which is great news.
Yeah. Your portfolio, one of the things you talked about is the fact that when you find some conviction somewhere, you're able to move the portfolio and tilt it towards that, and you do when you see the opportunities do that. Last time we spoke, the tilt was towards the mining companies. How do you look for the next 12 months? What does your portfolio tell us about your views?
Well, so we're still long the iron ore names, which include the likes of BHP and more recently Fortescue in the last quarter of last year. We added that. And the reason that we've stayed long is because we think iron ore prices are probably going to be stronger for longer. They're going to stay at more elevated levels. And what gives us a conviction there is that the supply disruptions in iron ore to date have been quite large, and we think they're going to be protracted. And the other thing we learned on our recent China trip is that the steel mills over there are remarkably complacent about the prospect of that supply returning, i.e. they think it's going to return quickly. And in our view, that's not going to happen. So those steel mills are likely short iron ore. They're running down inventories, and as we've seen in recent weeks with another 10% on the iron ore price, those steel mills are going to need to get back into the market and start buying more product to support inventories and steel production. So we're still long the iron ore names. We're also what we don't own includes some of the defensive stocks. We think the market's overpaying for some of the defensive names which have rallied very significantly post the collapse in long bond yields.
Yep.
And also some of
these are infrastructure style players.
Yeah, some of the infrastructure names, also some of the more expensive property trusts, which include the likes of Goodman Group and Dexus. And indeed, that's not a reflection on the quality of the businesses at all, because they're both high quality businesses. It's just that the valuations are unsupportable.
Really sensitive to those bond yields.
Absolutely, yeah. And I think the other thing, for some of the stocks in Matt's sector, they've absolutely benefited from those collapse in long bond yields as well, because that ultra long duration, high growth names can be quite sensitive to to moves in long bonds and a much lower discount rate. So the market said basically, if you've got free money, we'll give it to the companies growing the fastest, and that's.
Well, it reminds me a lot of when you started over here in 2007, and you had a situation. I mean, all of the property trusts were trading at significant premiums to NTA, and as a result, they were out just raising money. And I mean, why wouldn't they? You'd be crazy not to. So we're starting to see elements of that creep back into the market as well. Yeah.
I want to come to small and mids in a second. Just one final question. Big sector, hard to ignore. We've just come out of the Royal Commission for the banks.
Yeah.
Do they have a little bit of clean air ahead of them now? Now that that's sort of blown over? Well, not blown over now that it's finished.
Well, from a regulatory sense, there's perhaps more certainty, so that's a tick. But from a business perspective and an economic sense, Matt's already spoken about the difficulties with the domestic economy, and obviously the major banks are very housing related. So, we still see margin pressure. We don't see credit growth accelerating, and in fact, it's likely to continue to decelerate, but very modestly. And then cost growth as a result of regulatory impost is likely to continue to bite. So all that means for the major banks, you're probably not going to see any earnings growth in the foreseeable future.
Yep. It's a bit of the story, sort of that top end of town, really, isn't it? Matt, I know you can't talk so broadly in sectors when you talk to at the smaller end of the town. It tends to be a little bit more stock specific and esoteric. But what are some of the things when you look at what you hold, what you own? What does it sort of say about your view on the opportunity set in front of you?
Well, we're always out there turning over stones, and I mean, from a sector point of view, as Troy said, we're under, as I mentioned before, we're underweight domestic cyclicals. We're actually underweight regional banks that are even more exposed. Yeah. But in terms of some of the stocks in our sector, one of the big thematics that we are seeing in the market at the moment is on the infrastructure side. Obviously, it's been stronger for a long period of time. You'll see a lot of charts in terms of what is intended to be built, but the reality is the capacity doesn't actually exist to build that at the moment. So what we've constantly seen is that cycle's just been elongated, and in the budget last night we saw further announcements on infrastructure. So in our space, things like CIMIC, Downer exposed to that area. And you take Downer, for example. It's a really well managed company. If they hit their earnings this year, that will be the 8th time in a row that they've hit their earnings forecast. And yet the stocks, if you look at comparative companies overseas, it's trading at 30% discount. So to us, something like that looks very cheap. And we're just finding just different stocks out there. What we typically look for is stocks that for whatever reason are a bit unloved, but where we can see a catalyst for those stocks to get re-rated. And what you tend to find over time is if if the company does keep delivering, then over time the market will embrace it and re-rate it, and that becomes a powerful factor. So like another good example, say Chorus, which is the New Zealand broadband fibre rollout. And I know a lot of people over here hear about broadband fibre rollouts and go, oh, given the experience you've had, but it's actually a great product. Like, it's early days yet, 50% of people who can access that, the fibre have taken it up. And, so it's vastly superior to the copper that was in place. And, that's basically a stock that's going through a transition from being, a development company to an infrastructure company. So in the next 3 to 4 years, you'll basically see the capex of that company go down by 75%, and we'll start to see it go double-digit free cash flow. So to us, things like that, look really attractive, and we expect that to get re-rated over time.
Yeah. Final question, just because it's that time of year, we're leading into an election. If there is a change of government, do you see it as something that investors really need to have their finger on the pulse for, or does it tend to be one of these things that makes a lot of headlines but doesn't flow through into the stocks quite so much?
Yeah, I don't see it impacting markets that significantly, because I think, certainly from our perspective, there's a broader expectation that Labor are a shoo-in. So to the extent they are, it's probably priced in a lot of the names. Yeah, perhaps there's some idiosyncratic things that they're going to do which we haven't yet worked out, but in the main, I think that's a broader expectation for the market and ourselves. Yeah.
I mean, there are some policy specifics around, franking, negative gearing, and there's a lot of debate about take negative gearing, what that might mean, the changes there if they are introduced. So I think the proof will be in the eating for that. So we'll see. Yeah.
Great. Well, listen, thanks for being so open to cover a fair bit of ground. We've done a little bit of a whirlwind around the grounds, but thanks very much for taking the time to sit down and have a chat with us.
Pleasure.
Thank you.
Time.
Cheers. Thanks.